Hi, I'm Ron Wirtz, editor of the Fed-Gazette, here to tell you about the growing strength of rental housing markets in the 9th District. Over the last decade, rental markets have seen big swings in vacancy rates and building activity, mostly coinciding with the housing boom, the subsequent recession, and the sluggish recovery. As recently as 2010, vacancy rates were high across much of the 9th District, often ranging between 5 and 10% or even higher. But the sector is now experiencing something of a rental renaissance. Vacancy rates have plunged across the district. Sioux Falls, South Dakota, for example, went from 11% to under 5% in the span of about 2 years. Most of the larger cities in the district have seen something similar, with some vacancy rates reportedly below 1%. Those falling rates are due mostly to two basic factors. The first is strong demand, some of which is coming from home foreclosures. But with the return of job growth, however sluggish, additional demand is coming from unwinding households that consolidated during the recession, like young adults that moved home. But steady demand for rental housing is finding slim pickings, which is the result of a near shutdown in new multifamily construction after the recession. For example, in the Twin Cities metro, home to almost 200 cities and townships and almost 3 million people, the number of new multifamily units fell from an annual peak of about 7,000 to just 1,000. Minneapolis was permitting about 1,000 new units a year all by itself before the recession. During one 12-month period after the recession, it approved just 15. It wasn't quite as desperate among 13 other district metros, but annual new rental units still fell by about 50% from their peak, and would look much worse were it not for strong construction activity in North Dakota's 3 metro regions. The outlook for property owners is very positive. For much of the last decade, landlords haven't had much traction on rents. Since 2006, inflation-adjusted rents have been negative in many cities across the district. But over the last year and going forward, a variety of sources suggest higher rents are in the offing. Unfortunately, renters can face something of a scavenger hunt given low vacancy rates, especially for low-income households, because cheaper market rate units tend to have very low vacancy rates, while vacancies in public housing are virtually non-existent, and waiting lists for Section 8 vouchers have gotten ridiculously long. In some regions, there have also been almost as many demolitions as there are newly constructed affordable units. How long these conditions last will depend on the market's response to tight vacancy rates. There is evidence that more apartment construction is on the way. But demand is expected to stay strong as well, in part because we're not past the home foreclosure crisis yet. And some research suggests that pent-up demand from consolidated households is much higher now than in past economic recoveries. Some also believe the housing collapse has fundamentally changed people's perception of home ownership, which has fallen across the district and nation, particularly in Minnesota. Some have suggested the national rate of home ownership might dip towards 60%. As one source said, "I'm skeptical it will go that low, even on an interim basis, but I can't rule it out. Things that you thought couldn't happen before have." For much more on rental housing markets, as well as an article on the fast-growing frac sand mining industry, and a peek at the 9th District's economic forecast, see the July Fed-Gazette nearby. Thanks for watching, and be sure to follow us on Twitter at the following addresses.